and the implications for AT&T shareholders if this deal does fall through. Our next guest says it could be a severe negative. His firm is an AT&T shareholder. Lehman Capital Partners manages $5.4 billion in assets. Its chief investment officer, Jeff Davis, joins us now from Newton, Massachusetts. Good morning, Jeff. Thank you for joining us this morning.
Good morning. Great to be here.
This is the biggest M&A deal of the year. $39 billion, AT&T making that bid for T-Mobile. AT&T shares have outperformed the rest of the telecom sector since the deal was announced. Tell us just how much of a severe negative this would be for the stock.
Well, the question is about the industry, and it's important to remind everybody that AT&T used to be a monopoly, and the fear is that it's going to return to being a monopoly. And the question about this entire industry is whether it can survive as a fragmented small company business or whether it concentrates into a duopoly. And that's what the regulators are fighting. The problem is if you don't let a deal go through, or this is impossible to pull off, will AT&T be able to generate enough profit to attract shareholders in the future?
Will it be impossible to pull off given that both the DOJ and the FCC oppose it?
Well, that's a big negative. The other thing is that the plan to sell off assets technically could run into problems. The assets they have aren't necessarily of value to the smaller players who it appears that you can buy subscribers, but the technology and the spectrum might not be useful to the smaller players in the market. So that sale might not be able to practically be done. So that's going to be tricky.
So is this asset sale proposal, which is AT&T's, by the way, it's not something that the regulators necessarily mandated, is this the only remaining option for the company?
Well, it's an attractive one, and Verizon sold pieces of Alltel when it did that acquisition in order to satisfy regulators. So there's a precedent for this before. The question is whether it's practically feasible to do this to satisfy the regulators. That will downplay the monopolistic problems that it creates in some markets. So it remains to be seen. It's technically out of my realm of understanding, and so for a lot of investors, it might be too much to have to hope for regulators to win here.
Right. You might not want to wait this out. AT&T already is saying that it's going to take a $4 billion charge for the quarter to cover the breakup fee. Is that already conceding defeat?
Well, it certainly shows you that the lawyers are probably the winners here, but it's potentially getting ready for a conceding defeat. I think AT&T will be fine in the future. We're not aggressive buyers of this, but I think it's going to be fine. It's paying a decent dividend. It's
right,
not threatened, but it might not be profitable.
A near-term breakup of the Eurozone could provide some bank shares with a boost. His firm owns hundreds of millions of dollars in bank stocks. Jeff Davis back with us here on the Inside Track. So, Jeff, walk me through this argument. Most people are drawing the conclusion that a breakup of the Eurozone would be disastrous. Why don't you think that would be the case?
Well, a lot depends on the devil's in the details about how the breakup would occur. The good news is that you've had plenty of time for banks to prepare for the breakup. You can sort of see a lot of articles this morning in various papers about how banks are being prepared for, in the case of multiple currencies returning to, our daily lives. But the reality is you've had a good deal of write-downs. There's excessive I think speculation that things are probably worse than they truly are in many of the banks. There's been enough transparency, I think, on the U.S. side to allay a lot of worries on the U.S. banking side. The European banks are still kind of speculative. It's difficult for U.S. investors to get a good handle on where the exposure is in Europe. But at this point, the stock prices have sold down so much that the valuations are pretty attractive and compelling.
Well, attractive and compelling. Jeff, specifically, what banks do appear to be attractive and compelling to you over in Europe?
Well, there are the major banks that are. I can't go listing names for various reasons, but there are very strong banks both in Germany and in France that are well prepared and oversold. There are very selective banks, once they come out of nationalization, that you have to sort of look at, that goes through the UK and Spain. But at this point in time, it's not a high-quality bet. The valuations are as attractive as they've been in a long time. Uncertainty is really pushing the prices probably below fair value. And you don't have to have a big growth spurt in the banks for their valuations to be realized near term.
Jeff, if these banks were as well prepared as you believe them to be, why is it that they're dumping tens of billions of dollars, or at least tens of billions of euros in assets? I'm thinking of SocGen, for example, or BNP Paribas. These banks are aggressively trying to lever down. How is that well prepared for a crisis?
Well, you're still in a vicious circle of raising capital and making sure solvency and all the capital standards are up to what's an increasingly higher and higher hurdle for standards. So you're still in a vicious circle where they're trying to liquidate as much as they can. So you're still in a very speculative period. Now, there's a point in time where that cycle stops and reverses itself. You hope it's sooner rather than later.
That raises an important question, Jeff. I'm sorry to interrupt, but what is that point? What's going to be the catalyst, we like to say, for your views to be validated? What do you think needs to happen?
The missing piece, and it's the subject of, and you've talked about it already this morning, is the fiscal union. You have to have confidence that Europe has a foundation for managing their fiscal policy in the future. Without that, we're going to be in this vicious cycle for another period. That's the downside. The upside is, and it's too much to hope that December 9th, late next week, when the summit meeting comes to announce that there's something more tangible. But that could start it. It's difficult to say. It's been going on a long time. Mr. Market is not allowing the Eurozone enough time for them that they want to create fiscal union. But remember, this isn't a small deal. Wars have been fought over fiscal union in Europe over the past. So it takes a whole lot of patience and a whole lot of good risk management to get through this.
Indeed it will. Jeff, good to see you this morning, and thanks for your comments. Jeff Davis, the Chief Investment Officer at Lehman Capital, talking to us about banks plus the takeover efforts at AT&T.